Hello and welcome to another market update. Pretty slow week, I guess, other than crypto, as the whole industry falls apart, but we'll definitely get into it. With that out of the way, let's just jump straight into the summary of the top stories for this week.
My man!
So we got the Fed now strongly considering a move down to a 50 basis point hike. New home sales came in today, and they were actually a surprise to the upside.
Whoa.
Japan inflation hit 3.7% for headline and 3.6% for core.
Yep.
Doesn't sound that crazy, but it was a 40-year high. And the highest inflation Japan has, obviously, since its 40-year high, reached in a very long time, despite it not being even close to what the U.S. is experiencing.
Little bitch.
But anyway, and also Japan officials have now indicated, at least some of them, that they could be abandoning their loose monetary policy and yield curve control.
That crazy.
Obviously, nothing's for sure, but the current head of the Fed, Kuroda, like the J-PAL of Japan, is going to be leaving soon, I think in the start of maybe like Q1 next year, and his potential predecessor is maybe not as dovish as him, let's say. But again, we'll get into it. Let's keep going. So we also had a story about the ECB set to raise rates by 50 basis points. That's still not for, I think, until like December, mid-December or early December. So we got a while, but still planning on a 50 basis point hike. Saudi Arabia had denied rumors of an OPEC plus production cut.
Come on, man.
And oil has just been going crazy because of that. It's like up 5%, down 5%. It's down again. I'm not 100% sure why, but I don't think Saudi Arabia is going to be cutting anytime soon. And then finally, of course, an update on the crypto madness. FTX Contagion takes another victim, Genesis, but its parent company, DCG, or a Digital Currency Group, I believe, says it won't affect the GRAYSCALE trust. They're all part of the same umbrella, so that is problematic, potentially. At least a lot of people were assuming it's going to be. But they are reassuring investors, but we all know how that works. But before we get into those stories, let's go over last week so we can stay up to date. So we had U.S. inflation came in at 7.7% for headline and 6.3% for core.
My man.
Now, juxtaposing that with the Japan numbers, that sounds crazy, but those were surprises to the downside, and the markets were very happy. And then Fed officials said they still see tighter monetary policy ahead.
What?
But we'll get into one of our stories about them, setting the scene for potentially lowering the pace of the rate hikes. And then we had producer price index numbers, which is like inflation for producers, essentially. Also surprise to the downside. Japan's inflation was expected to hit a 40-year high, and it did.
Damn!
And then we had they're not in place yet, but we have EU oil sanctions that are driving Russian oil to Asia. I believe those go into effect something like December 5th.
Say what?
And then, of course, FTX Contagion wrecked BlockFi. It just keeps tearing its way through the industry. But BlockFi has now filed for bankruptcy.
Little bitch.
I actually had their credit card, so no longer can use that. But other than that, didn't get screwed over too much. But obviously, stay tuned. Anyway, with that out of the way, let's transition to our first story. All right, let me get my webcam. Where am I? There we go. All right, so first story, the Fed. Make sure you get rid of this real quick. All right, so the Fed Waller, one of the Fed chairs, says he's open to a half-point rate hike at the next December meeting. So Federal Reserve Governor Christopher Waller said Wednesday he's open to reducing the level of interest rate increases soon, so long as the economic data cooperates. Now, they've been saying this stuff for a long time, being data-driven, taking the data approach, like whatever comes in, if it's good or bad, then they'll just kind of take that in stride and adjust monetary policy or their decisions accordingly. But they're really starting to change their tune a little bit, just because there are a lot of, the economy is slowing. There are a lot of leading indicators showing that these rate hikes are going to affect the economy in a very material way. And so I guess they're finally starting to be a little bit more, conscious of that. So he actually laid out, I'll get into it, but he laid out some things that the Fed, or I guess him specifically, he specifically are going to be looking for in terms of adjusting their rate hikes to the downside, like 75 going down to 50. So the rate setting Federal Open Market Committee is set to meet December 13th to 14th. And market expectations are running high that policymakers will approve another rate hike, but this time opting for a 50 basis point hike move instead of the 75 basis point hike that they've been doing for the last 4 consecutive meetings.
Yep.
So looking toward the FOMC's December meeting, the data of the past few weeks have made me, this is again Waller, more comfortable considering stepping down to a 50 basis point hike. Waller said in prepared remarks for an event in Phoenix, but I won't be making a judgment about that until I see more data, including the next PCE inflation report and the next jobs report. So investors have grown optimistic that a lower than expected increase in October's consumer price index, CPI numbers, is indicative that inflation is cooling. Headline CPI increased 0.4% for the month and 7.7% from a year ago, while the core reading, excluding food and energy, rose 0.3% and 6.3% respectively. Now again, all those numbers sound terrible, but it's, from the perspective of the market, it's all about the rate of change. And I guess expectations in general. You expect inflation to come in at 8%, it comes in at 7.7%, the market rallies. It's a little stupid because the absolute numbers are not ideal by any stretch of the imagination. I mean, especially if your goal is the 2% target, which the Fed has clearly outlined. But, we're talking about, the rate of change, especially if you consider that these rate hikes act with long and variable lags. So if inflation is peaking now or slowing down now, and the monetary policy, or like the hikes from monetary policy, or how the Fed is tackling monetary policy right now, haven't even hit the economy yet, because the last 75 basis point hike is maybe not going to really affect the economy or like the interest rate sensitive parts of the economy until like 6 to 12 months later. Then it maybe isn't smart to keep raising rates until those hit, because inflation is already headed down. You don't want to, it's like you already got the nail into the piece of wood, and you just keep smashing the piece of wood until the nail basically just breaks the piece of wood. And that's not exactly the best approach, but it's difficult from their perspective, understandably, to I guess tackle this stuff when there is this lag, because imagine trying to implement some sort of change in the economy that you don't really see materialize until like a year later. But anyway, they're starting to be more conscious of that. That's basically the moral of the story. Here's a quote. Though welcome news, we must be cautious about reading too much into one inflation report. I don't know how sustained this deceleration in consumer prices will be. I cannot emphasize enough that one report does not make a trend.
No!
It is way too early to conclude that inflation is headed sustainably down, because a lot of people think as soon as inflation goes down, that's the end of it. The Fed can stop, but they are very, very worried, acutely worried of inflation resurging, coming back. Maybe it gets down to 3% and then comes back with a vengeance, like to 7 or 8% again. And that's actually what we saw in the 70s, and why the Fed and Powell specifically, who obviously matters the most in with regard to this monetary policy, why he has said that they are going to have higher rates for longer, because they don't want to cut rates and then have inflation come back. They want to raise rates, keep them there for an extended period of time. Some people speculate like even a year or longer, which is pretty wild. But keeping them for a long time to make sure that inflation is, truly squashed and doesn't have this like double top where it comes back after being, tricking us into thinking that it has gone back down to a more normalized level. And here's the last little bit. In making his assessment, Waller said he will be looking at 3 principal data points apart from the broad inflation readings: core goods prices, housing, and non-housing services. He said he's seeing encouraging signs in all 3 fronts, but will need to see more, and vowed not to be head-faked by one report. Now, this is relevant because our next story about U.S. housing sales, because he just said right here that one of the three main things that you'd be looking at, aside from the actual inflation indices, is housing. So, we just had new home sales come out, and they surprised to the upside. So, in that sense, not exactly what he would want to see to let his foot off the gas, or for the Fed to let their foot off the gas and, lower the rate of, or the pace of rate hikes. Aww. But with that said, let's transition to the home sales story. So new home sales in the United States rose by 7.5% to a seasonally adjusted annualized rate of 632,000 in October, beating the market forecast of 570,000. So a pretty meaningful beat. And these sales are defying the recent drawdown in housing demand as the Federal Reserve aggressively tightens monetary policy. So basically, housing is one of the most interest rate sensitive areas of the economy, and you can, a pretty easy way to, measure that or kind of understand why it is so interest rate sensitive is mortgage rates drive the housing market, one of the biggest reasons that people buy or sell or are able to buy more or sell more, because if you have interest rates or mortgage rates specifically going way higher, that just means you can't afford the same house. You maybe don't want to sell your house because if you got a fixed interest or mortgage rate, locked in at 2-3%, and now they're at 7%, you don't really want to refinance or get a new house that forces you to refinance because you're going to be paying a way higher mortgage. So a lot of people are assuming that there's going to be this housing freeze. Nobody wants to buy or sell, and so the housing market just kind of stays real flat, real quiet. So this, recent new sales print that came out is, it's not a crazy one. If you look at this chart, you can see that it definitely beat last month of 588,000, but the month before that was 661. So it's not like it just completely blew up to the upside or anything, but still you'd be expecting with mortgage rates rising so aggressively. And I think they've actually come off their highs. They're below 7% again. It's still pretty wild considering they, less than a year ago were at 3%. So they're more than doubled. But they aren't getting super crazy. But either way, this is not the direction that the Fed wants them to be headed. They want to see tightening conditions. They don't want to see housing, be edging higher in terms of demand and overall activity, because housing is one of the biggest drivers in the economy overall. Just because when you buy a house, number one, it's just a huge purchase, but the building of houses requires a lot of jobs. A lot of people building, a lot of people furnishing. When you go to furnish your house, you buy a new home, you buy all these new things like furniture, housing supplies, appliances, whatever it is, and that just creates a lot of demand for the economy more broadly. So housing freezing, or whatever direction housing is going, people often say the economy follows. So the Fed watches housing, understandably very closely, and if housing is going the wrong direction, in terms of, demand or its effect on the economy in terms of driving demand, then they are, that's not exactly what they just want. That's not what they want to see right now. They want to see the housing market tapering off a little bit, because that shows that their monetary policy changes. The rate hikes are starting to finally hurt demand, and people aren't, spending as much money building new houses, and just overall the economy is slowing down, because it sounds a little counterintuitive, but they want that right now to tame inflation. So this is, again, not a crazy print to the upside, 632,000 versus the previous month, 588, but still showing that the housing market is not necessarily fully squashed, or it's not, despite all these crazy rises in mortgage rates, it's still holding up, at least this last month in October. But anyway, just to highlight or underscore, the reason this is important is because we have Fed officials, Fed Waller, saying he is focused on, housing specifically, as one of the main factors that the Fed and he will be looking at for lowering the pace of rate hikes, or decreasing the rate of rate hikes. You know what I'm saying?
Totally.
All right, well, let's transition to our next story. So, inflation in Japan climbed to 3.7% in October, the highest reading since January 1991.
God damn!
And from 3% a month earlier, amid high prices of imported raw commodities and persistent yen weakness. Now, the yen has actually come off its highs pretty, substantially. So that's going to alleviate some of these inflationary pressures. I'm not going to pull up the chart right now, but the dollar in general has been on a pretty steep retracement, and so it's not just the yen that I guess is gained in relative terms to the dollar. It's been a lot of the other currencies. Euro, British pound, pretty much all of them, just because the dollar in general was just so overbought, I guess, or overextended. So that should alleviate some of the pressures, at least, unless the dollar, continues that upward trend. But right now, next month, I guess, you may not see quite as aggressive of a inflation print, just given the yen is going to alleviate some of that pressure. But as it stands for this previous month, it was pretty aggressive. Everything, in all the different baskets, accelerated pretty aggressively. And if you look at this chart, you can just see, so the previous 2 months before this were both flat at 3%, and then we had a huge jump to 3.7, and 70 basis points, for especially considering you're not at a super high level already, like 9%, is a pretty big deal. So core consumer prices also increased by 3.6% year over year, the most since February 1982, higher than forecast of 3.5%, and above the Bank of Japan's 2% target for the 7th straight month. On a monthly basis, consumer prices went up 0.6% in October, the steepest increase since April 2014. So it's not just that it's a very high print, or like a 40-year, 30-year, whatever high. It's also the rate of change is pretty aggressive. Not, I guess, that historic, since 2014, but still, the rate of change is always very important, because if inflation is accelerating at 70 basis points each month, that is pretty bad. Whereas, like, if the next print was 3.8, you're like, okay, well, at least the rate of change isn't rapidly increasing. But yeah, what I alluded to before, pretty much all the different baskets for Japan's inflation were not good. So I guess I'll point out some specific ones. So electricity was 10.9% the previous month, I believe, and then 21.5% the most recent one. Gas up like 20%. And what we got? Household utensils. Nobody cares about that. But overall broad-based inflation. And it's kind of funny because after, hearing this, 40-year highs of inflation and just this kind of record number of 3.7%, you also have the Bank of Japan talking about abandoning its loose monetary policy. Maybe this is kind of inspiring them that this is not a good approach. So I guess on that note, let's go ahead and transition to that story. So the Bank of Japan may adjust ultra-loose policy before Kuroda, who is the Jay Powell of Japan, before his term ends, former central bank executive says. The Bank of Japan may adjust its ultra-loose monetary policy before dovish Governor Kuroda's term ends next April, if the economy strengthens enough to spur higher wages. Any such move would be aimed at addressing the demerits of prolonged easing, such as market distortions caused by the Bank of Japan's huge presence, and not a tightening monetary policy. Global rising inflation has exposed the distortions caused by Japan's monetary policy. And here's a quote: "By keeping long-term rates fixed, the Bank of Japan is causing volatility in the currency market." No shit. And maybe hurting the economy by accelerating unwelcome yen falls. Now, their ultra-loose monetary policy, as everyone always calls it, it just ends up leading to the currency, the yen, being the release valve. So they pin rates, below what their, I guess, natural market rate would be, their yields for like their 10-year or just their bonds in general, and that just leads to the yen being the release valve and depreciating rapidly against other currencies, and that's what's driving this inflation, largely driving this inflation. And now that inflation for Japan is at 3.7%, which is well above their target, and the accelerated pretty rapidly. I'm sure this is somewhat influencing it. They've been doing this loose monetary policy, yield curve control for a very, very long time. But they haven't had inflation like this at all. Evidenced by the fact that it's like at 40-year highs. So it's definitely maybe starting to cause some, conversations among Bank of Japan officials to reconsider their ultra loose monetary policy. But given how much debt they have, which is like 300% debt to GDP, it seems, I guess, I wouldn't hold your breath. I wouldn't expect the Bank of Japan to abandon this, because if rates rise too much, I mean, they're going to implode. They can't refinance and roll over those debts at a higher interest rate because they have so much debt. Even if those rates rose to, like what we're seeing in the U.S., like 4% right now, that's just not sustainable. I mean, people are talking about it not being sustainable for the U.S. when Japan has, because I think the U.S. right now is like around 130% debt to GDP. And so Japan at 300%, and they don't have the global reserve currency. So there is, that demand factor for the yen. It's not nearly as strong as for the dollar. Like, the dollar is going to always have a bid because it is the global reserve currency. So that affords the U.S. a lot more wiggle room in that regard. But the Bank of Japan does not have that. So if they abandon their, yield curve control and rates start getting to their natural market force or their natural market price, I mean, who knows what that ends up being? Maybe 3-4%, but I don't see how that's sustainable for them. So we'll see if this is just kind of talk. But let me go ahead and continue. So the Bank of Japan should allow long-term interest rates to rise more in line with higher global yields, such as by targeting some of these Reuters people. I don't know how they write. It's terrible. Such as by targeting a shorter duration than the current 10-year yield. At some point in the future, the Bank of Japan needs to adjust its policy. There's a chance the Bank of Japan could do so sometime during the latter half of the current fiscal year, ending in March 2023. So I guess they're giving themselves a decent window for when that happens. And, maybe they're just planning on inflation being completely done by then. In which case, it almost doesn't really make sense to abandon the loose monetary policy, because inflation's down. You maybe even want to generate inflation because of all the deflation or disinflation you're experiencing.
Whoa.
But either way, I thought this was pretty meaningful, just because the Bank of Japan is not, I mean, they've been maintaining this policy stance for a very, very long time. So for them to be talking about, considering abandoning it is pretty big, and that could have serious implications for the world, especially if Japan abandoned and blew up. One of the biggest central banks in the world has a debt crisis from a debt spiral of not being able to refinance their debts. That's going to, you think FTX was a contagion issue. I mean, this is going to be like global contagion on one of the, the highest scales possible. And we got the last little bit here. So it's inappropriate to change monetary policy right now, but when economic and price conditions fall into place, the Bank of Japan must act because yield curve control and negative interest rates are no longer necessary in Japan.
Not crazy.
I'm not sure why exactly they think it's, I guess it's, it's never necessary, right? Like, you're intervening in the market. Maybe it depends on your economic philosophy, but I'm curious why he says that they're not necessary, like what specifically he's pointing to. We'll have to see if that, I'll try to keep updated on this story to see what happens, because I'm definitely very interested. But I would say by the time April rolls around, because that's when Kuroda's term ends, we maybe find out who his successor is, and then we'll see if they are because there's a number of different candidates, and I think one of the ones they were considering is this one who's a little bit more hawkish. So we'll have to see who actually ends up succeeding Kuroda, because whatever their stance is, that's going to be a big deal. And who knows, maybe in the latter half of 2023 we see Japan blow up. But on that positive note, let's transition to our next story. So the ECB is set to raise its interest rates by 50 basis points at its next meeting. I think it says somewhere in here when the meeting is. I want to say it's in early December. So the European Central Bank will press on with policy tightening, adding 50 basis points to its deposit rate next month, as it worries rapid price growth is becoming entrenched. It's a big thing central banks are worried about. They don't want inflation expectations to become entrenched because they feel like it's this, self-reinforcing feedback loop. You think prices are going to get higher, so you spend more and increase the velocity of money, which puts upward pressure on inflation. There's some logic to it, but in general, I think central banks are a little bit too focused on inflation expectations, but neither here nor there. And all this is despite the bloc, European Union in general, almost certainly entering a recession. So they're going to be hiking into a recession. The UK is also like that. They basically said that they're going to have a recession for the next 2 years or something, which is fucking wild. And they are still raising rates. So raising interest rates into what you're predicting to be a 2-year-long recession is, unprecedented. I can't even, not that I'm that old, but I can't remember a time when that happened. So it will lift its deposit rate by another 50 basis points on December 15th. Yeah, so mid-December, taking it to 2%. That'll tackle that 9% inflation.
You're a fucking idiot.
And do the same to its refinancing rate, putting it at 2.5%, according to the median forecast of a Reuters poll. That deposit rate view was held by a majority of 45 of 65 respondents, while 14 said it would add another 75 basis points, as it has done at its previous 2 meetings. Only 3 said it would opt for a modest 25 basis point increase. Yeah, so 3 people, that's not happening.
And we say bye-bye!
Yeah, so 50 basis points seems to be the expectation right now. Obviously, things can change over time with some whatever development, as inflation numbers come out or jobs numbers or, whatever happens. But definitely expect, as it stands right now, a 50 basis point hike. And I've been going back and forth on whether or not I think the ECB will hike beyond what the Fed does. Most central banks right now are hiking because the Fed is hiking. They can't really afford not to, because if they don't while the Fed does, it's just going to put so much pressure on their currencies and add to the inflation that they're already seeing. So but if the Fed stops, I don't know if they want to continue because, like we already talked about, they are headed into a recession. They're predicting they're going to be in a recession. So hiking into a recession is not usually ideal. So absent the Fed kind of forcing their hand a little bit, because it's raising rates and in that sense forcing them to raise rates, I don't know if they would continue beyond, like if the Fed slowed their rate hikes to, literally pause. I can't see them, continuing beyond what the Fed does. It's very possible that, maybe the Fed tames inflation earlier and faster. We've already seen our inflation numbers kind of come down and, head in the right direction, right now, which may eventually lead to the Fed pausing or reducing its rate hikes. But if the ECB or UK or whatever, they still have some crazy inflation that doesn't look like it's peaked, or it's just stickier in whatever way, then maybe they do raise rates more, in the long term, like, say the Fed goes down to 25 basis points or even just pauses. Maybe the ECB or whoever, they continue doing 50 basis point hikes. I don't know. I still find that unlikely. But as long as we have the Fed raising interest rates, expected also to raise interest rates by 50 basis points at its next meeting, we will probably see major central banks like the ECB doing the same. It's just my guess. But obviously we'll have to see how that develops. So December's move will be followed by another 50 basis point increase next quarter. Again, these are all projections. Nothing is for certain. Given peaks in the current cycle of 2.5% and 3% for the deposit and refinancing rates, unchanged from an October poll. More resilient economic conditions, stickiness of inflation, potential spillovers onto inflation expectations, and longer-lasting wage pressures could force the ECB to keep tightening for longer into 2023 than we currently predict. And that is Ken Wattrit, Vice President of the S&P Global Market Intelligence, saying that. And then last little bit of this piece, it will take time for tighter monetary policy to meaningfully tame inflation. And while 13 of 23 respondents to an additional question said inflation had already peaked, it was not seen at the bank's target interest rate of 2% until at least 2025.
Whoa.
So even with inflation peaking, projections right now, and obviously take them with a grain of salt because economic projections are, most of the time dog shit. But they are not projecting inflation to get back down to their 2% target until 2025. That's pretty wild. So yeah, maybe, like I was kind of talking about, that motivates them to raise rates beyond what the Fed does. But I just don't see that happening just because they are going to be hiking into a recession. And if you take away the pressure to raise rates from the Fed raising rates, then I don't know, it's easier for them to just be like, all right, we're going to, not hike into this recession. And then they just start, kind of scapegoating inflation. They're like, oh, it's because of the supply chains. It's because of Russia. We can't do anything with our interest rates. They don't help. So why would we raise interest rates anyway if it doesn't help? Something tells me that rhetoric will kind of surface. But yeah, I guess moral of the story, despite all these tangents I'm beginning into, ECB set to raise 50 basis points in line with the Fed at its next meeting, December 15th. All right, next story. Whoops. Okay, so Saudi Arabia, there was a rumor that Saudi Arabia and I guess OPEC Plus, more specifically, was going to increase production, and because they a few meetings ago, OPEC, they meet like every month or so. A few meetings ago, they cut production by what they were planning on their production being, because they were already kind of underproducing. Small little, caveat, but they were going to cut production or their total output by 2 million barrels. And then there was some rumor that they were going to increase production by 500,000 barrels per day for both those numbers. But they came out and denied that, saying that they do not plan to increase and they may even cut further. But I'll just go ahead and get into this story. So Saudi Arabia on Monday said that OPEC Plus was sticking with oil output cuts and could take further measures to balance the market amid falling prices, denying a report it was considering boosting output. Yeah, so they squashed that pretty fast. The Saudi Arabia oil minister, I think that's his title, whatever it is, he has been talking about the disconnect between the paper markets and the spot market, saying that the spot market is way tighter than what the futures markets are indicating, because they're actually in backwardation right now, meaning that the spot price of oil is higher than the futures contract. So just as a basic example, oil is trading at $80. You have contracts for December, January, February, March, April, down the line, all trading at maybe $75 or even $70 the further down you go, essentially pricing in oil getting cheaper because of demand destruction or whatever. And the Saudi oil minister is saying that doesn't reflect the spot market and the tightness of the spot market. And they've been saying for a while that as demand falls off for oil, globally, they are willing to, counter that by cutting production further, basically trying to keep prices at least at a steady spot, or even higher. I mean, obviously they have a financial incentive here. But let me go ahead and continue on. The Wall Street Journal earlier on Monday reported an output increase of 500,000 barrels per day was under discussion for the next meeting of OPEC and its allies, known as OPEC Plus, on December 4th. The report cited unidentified OPEC delegates. It is well known that OPEC Plus does not discuss any decisions ahead of the meeting. Saudi Arabian Energy Minister, that's what it is. Saudi Arabian Energy Minister Prince Abdulaziz bin Salman, their names are always so crazy, was quoted by state news agency SPA as saying, referring to the group's next meeting in December. So basically saying that, no, we're not fucking doing that. We're not going to increase production. And, they definitely didn't take long at all for them to say that. Might have even been the same day. I think when I was watching oil, it dipped down 5%. And then after he came back that same day, the energy minister, and made these comments, oil rebounded 4% instantly. It just went pretty wild. So the energy minister was also quoted as saying OPEC Plus was ready to reduce output further if needed. So not only did he come out and say they are not going to increase production, he's like, actually, we might fucking decrease it even more.
And we say bye-bye.
It's pretty, it's just so funny. It's like spitting in Biden's face too, because Biden's been asking Saudi Arabia to increase oil production for a while, obviously to combat gas prices. Although now that we're past the midterms, I don't know if he cares that much. But still, cutting production right now is definitely a slap in the face to most of the Western world, especially Biden.
Come on, man.
The current cut of 2 million barrels per day by OPEC continues until the end of 2023. And if there is need to take further measures by reducing production to balance supply and demand, we always remain ready to intervene. So they are not, shying away here. They're being very clear that they will not be increasing production. They have no plans to increase production. And if anything, they will be decreasing it further to prevent prices from slipping. Now, it doesn't mean there's necessarily a floor on oil. I mean, I think oil was down like 4 or 5% today. So who the fuck knows? I wouldn't be surprised if it starts going back down to like the $70 level. But you got to keep in mind, number one, Saudi Arabia, OPEC Plus, they are being very clear that they are going to kind of have this implicit floor on oil. Like if it gets too low, they're going to cut supply. And obviously that will affect price in to the upside, presumably. And then you also have the U.S. who was, basically emptied their SPR, the Strategic Petroleum Reserve. At some point, they're going to have to fill that up, meaning they're going to have to be a significant buyer in an otherwise tight market. And they've toyed around with saying they're going to buy oil. I think previously they said like at $80, and then they took that back, and now they're like saying 70 or something. I don't know. But that's a huge deal because they are a huge buyer. And if the market and supply overall is kind of tight, especially with OPEC Plus or Saudi Arabia cutting supply, and then you have the U.S. trying to fill the SPR and buying, millions of barrels per week or day or whatever it is, because you have to keep in mind they were releasing about 1 million barrels per day, to help combat gas prices, but they're eventually going to have to fill that up, and that might translate to buying 1 million barrels per day at, like $70, $60, $65. Who knows what it's going to be. They really shouldn't stay. It's kind of stupid. They don't understand markets if they're doing that. But yeah, so oil definitely could fall further, especially with all this, global recession, this global recession narrative kind of taking hold. But I still think just given OPEC Plus, who is, when it comes to oil, the marginal supplier has all the power. So when OPEC Plus is, for the most part, they have most of the power in terms of raising and decreasing the overall supply, even if it's just like a few percent, because they are the ones primarily affecting and adjusting that. They are the ones that primarily control the price. And if they are going to, stay true to this goal of, cutting supply to combat lower prices and really trying to hold oil higher, and we also have, the United States trying to refill the SPR, that definitely is, it's certainly not bearish for oil. I will say that, especially when you consider all the underinvestment and overall, regulatory problems that have prevented investment into energy and fossil fuel industry like oil in general. In the coming years, it definitely, like I said, definitely not bearish for energy. All right, let's wrap this up real quick. So the Wall Street Journal said talk of a production increase has emerged after U.S. President Joe Biden's administration told a federal court judge that Saudi Crown Prince Mohammed bin Salman should have sovereign immunity from a U.S. federal lawsuit related to the killing of Saudi journalist Jamal Khashoggi. So basically, after the Biden administration told the federal court that they were not going to step on MBS's toes for this Jamal Khashoggi thing, where I'm presuming that people know what I'm talking about the Saudi government essentially murdering a journalist, and this was kind of a big deal. And he, Biden administration is basically turning the other cheek, saying, don't prosecute him or whatever, step on his toes, and because he wants to play ball, get oil, get the Saudi Arabians to go along with whatever oil demands Biden has. So this kind of concession is, I guess, maybe where these people got this idea that this $500,000 or 500,000 barrel increase was possible. But I'm curious to see if they're going to renege that and say, we're no longer offering immunity because you're not helping us at all on the oil front. But yeah, I thought that was a very interesting part. Maybe why some people were misled into thinking that this oil increase in output was possible. But yeah, who knows? All right, so the immunity decision amounted to a concession to Prince Mohammed, bolstering his standing as the kingdom's de facto ruler after the Biden administration tried for months to isolate him. I'm honestly probably going to let that last part out. But yeah, you get the moral of the story. OPEC Plus is not playing ball, even despite that, I guess, concession to not, attack MBS for, killing a journalist to try to get them to play ball with the oil market. But yeah, I don't know. I think I've talked enough about the oil story. So let's transition to the big story, or I suppose, in terms of the evolving story of crypto. So another one bites the dust. We have, so GRAYSCALE is, for those who don't know, they have a Bitcoin trust. I guess they also have like Ethereum and Solana. They have a bunch of cryptocurrency trusts, and it's because we don't have any crypto ETFs, like a Bitcoin ETF or anything like that. This has been kind of the de facto way that institutional investors or just anyone in like their 401k who doesn't buy, spot crypto off of an exchange or self-custody it, that kind of thing. This is how they invest in crypto, and it's kind of like it is a huge deal because it is like the biggest investment vehicle for a lot of people, to get exposure to crypto. And their parent company, who also owns Genesis, and a lot of people are drawing into question, I guess, the solvency or the security of the GRAYSCALE trust now, because Genesis is looking like it's going to file for bankruptcy, and they're strongly considering it. And that story could break really any day now. It seems pretty likely that they're going to file for bankruptcy. And so they're basically trying to reassure investors that in the event Genesis files for bankruptcy, creditors will not have a claim on GBTC assets, or I guess other assets for their other crypto trusts. But because a lot of people were worried that, if this happens and Genesis needs, money, like, because again, they are a subsidiary of Digital Currency Group, which owns the GRAYSCALE trust, then, maybe investors investing in GRAYSCALE or one of these other crypto trusts are going to lose their money. But yeah, I guess I'll just get into the story. So yeah, GRAYSCALE Bitcoin Trust is protected from fallout at sibling company Genesis Global. The GRAYSCALE Bitcoin Trust, ticker GBTC, is drawing market attention after sister company Genesis Global Capital said its lending unit would halt customer withdrawals as a result of fallout from the collapse of Sam Bankman-Fried's FTX crypto empire. The situation at Genesis, however, does not directly affect GBTC, the report said. Even if Genesis is unable to raise liquidity for its lending book and files for bankruptcy, creditors would have no claim on GBTC assets. GRAYSCALE Investments, which manages GBTC, and Genesis are both owned by Digital Currency Group, DCG, as is CoinDesk, which this article is written by. Kind of funny. So the market is concerned that GRAYSCALE could be considered for strategic options in case of catastrophe, the note said, but DCG, even in the most adverse scenario, would prefer to hold on to GRAYSCALE over Genesis, it said. So they're saying like they'll abandon Genesis to save GRAYSCALE if necessary, because GRAYSCALE is like their flagship business. It's the one they care about the most. It's actually literally what they say. So GRAYSCALE, DCG's flagship business and its cash cow is GBTC, generates around $300 million a year in fees. GBTC is currently trading at a massive 45% discount to the price of the underlying Bitcoin it holds. So it's called NAV, or net asset value, of the Bitcoin they hold. Say it's like 60, just for simplicity's sake, like $100 million of Bitcoin, but it's trading as if it holds 55 million Bitcoin, right? So a 45% discount. So if I can't remember the actual price math, but I want to say that right now the GBTC trust is basically trading as if Bitcoin was at like 10,000 or 11,000. So it's a pretty substantial discount. I mean, 45%, pretty pretty big. And this was before any of this happened. There was already a huge discount. The discount was somewhat added to, I guess, as people got nervous about the FTX Contagion and how it might affect DCG and the Grayscale Trust. But that discount was already there. It was already pretty aggressive, like in the 40% or something like that. So it's not like this is the reason that there is a huge discount. It's been around for a while. But anyway, let me just continue. So, meaning investors are trapped in an investment vehicle. They can exit only after a 6-month lock-in period and with a significant discount. So that's part of the reason I guess it has a discount is because you get locked in when you buy the trust. You have to stay in it for 6 months. I'm not sure how true that is. I mean, everybody always says it, but I don't know why. I feel like I've bought and sold it, so who knows. But either way, this is definitely something you want to watch, because if Grayscale goes down and that affects the Grayscale Trust, I mean, that is going to be huge because it is one of the biggest investment vehicles for Bitcoin. I don't know how much institutional money is still involved in it or invested in it, but that was one of the main ways institutions got exposure to Bitcoin. So it's possible that, say it goes under. I mean, again, I don't think it will, because they're saying that the assets are held and like at Coinbase and at different custodians, and so like the assets are there one for one. Again, we've heard that before, so take it with a grain of salt. But I don't know. I doubt it's going to affect investors, but if it did, I mean, that would be huge, especially, as I kind of alluded to, if institutional investors are invested, because then you have the contagion effect of, what else are they invested in? I mean, if some institution invested in Bitcoin is also invested in a bunch of like US equities or bonds or something, and they get some crazy margin call or they lose, millions of dollars off of the Grayscale investment, then maybe they have to sell all this other stuff, and that leads to a whole host of problems and just like, fire sales across markets, which would be pretty wild.
Not crazy.
But yeah, that is all I have story-wise. But before I get out of here, let's go ahead and transition to what to look for next week. Not anything too crazy. We don't have a lot going on. But later today, we have the FOMC minutes. Might even be in like a couple hours. By the time this comes out, it'll probably already be out. But that'll be probably the most important thing to watch out for. And then obviously tomorrow is Thanksgiving. U.S. markets at least will be closed. We have half day of trading on Friday if anyone is looking to trade, trying to get away from the fam. And then next Tuesday, we get German inflation numbers and Canada GDP numbers if anyone cares. And finally, just enjoy the long weekend. Don't focus on markets too much. I'm going to try to just eat myself into a coma, not focus on all this craziness too much. But yeah, on that note, as always, stay happy, humble, and most importantly, solvent. I'll catch you all next week.